But we're timing anyway.
Yeah.
Okay.
Welcome everyone to a battle of the strategies, opinions, beliefs, views, whatever. It's about to get real, people. Right, let's go round one. What are we talking about?
We're talking about debt, actually, and we haven't had this conversation in private, so this is like all gonna come out.
Okay, this is okay.
Okay, so I wanted to talk about because we were thinking about mortgage valuations, and I invest in HMOs, you invest in buy-to-lets. So your strategy, you always do bricks and mortar valuations.
There's no other choice yet.
Yes, whereas HMOs, you can have commercial valuations or you can have bricks and mortar, and I've heard this crazy...
What's the difference between both?
Yeah, let me explain that. And I've heard this other crazy new thing called a hybrid.
Hybrid, yep, like Toyota Prius evaluations, yeah, that's the thing. Go on.
Right, but we won't talk about hybrids because I don't really know that much about them, and I think a lot of brokers don't either.
Ooh, sure.
So, okay, you explain bricks and mortar valuations.
Bricks and mortar valuation is literally how much is the bricks and the mortar and the physicality of the house worth. So as a place where someone can live, as a block of materials, you know, what is this house worth physically? That's it. Rent, whatever, none of that stuff matters.
None of that matters.
What are the bricks and mortar around you worth?
And how do lenders, people, how do you get to the idea that this is the bricks and mortar valuation of the property?
So looking at sold comparables, looking at the size of property, square footage, working on your average square footage price and going against it within 6 months, up to, I've seen them go up to 2.5 miles.
Really? Crazy.
Yeah, I've had a nice big
that would
valuation.
not happen in London.
Oh yeah, every street is different in London. But yeah, that's how I do end valuations.
Okay.
But it's a dark art and it always is tricky.
So HMOs, commercial valuations, if you don't know, briefly explain. If say you take a pub and it's been converted into a 21 bed HMO, there is not a 21 bed property in the vicinity for one to go, yeah, this is what this property would be worth if I was selling it on the open market. So lenders go, okay, let's take the rent roll, times it by a multiplier, and then take a little bit of a discount off for voids, bills, whatever. So, you know, in different areas, the multiplier can be something different. So I won't, you know, you could just go speak to brokers and just figure it out what it can be. But like say just like a basic thing, like a pub that you bought for say maybe 200,000, spend 150 on the renovation, it's not now worth 350. The rent roll could mean that those like 20 bedrooms were earning £500 each, which is times 20.
Times 20, but that sounds like a fairer way to do it. Because, you know, it is a income generating asset, so it should be valued as such, not just bricks, right?
Exactly, yeah. And also when it was like a pub or a restaurant, it was generating a different type of income to when it's then a HMO. So that makes sense. I understand commercial valuations, there is a need for them when there isn't a actual comparable in the market, in the vicinity.
Yeah.
However, so I do conversions of 2 to 3 beds into 5 bed ensuite properties. Now, a lot of investors do commercial valuations on the 5 beds. I kind of disagree with this, and it follows on into debt, and that's what we're going to battle about, or I'm going to find out your opinion. So when you are taking a house that has a bricks and mortar valuation and it's a 5 bed, and there are 5 bed properties in the area, they're just a little bit further away, again you take into consideration the square footage, you are when you do a commercial valuation, you're overinflating the price.
Yes, I agree and disagree, because you like materially a 5 bed HMO is, especially if it's all en suites, is physically different to a 5 bed, you know, mansion down the road.
Yes.
And also that on an AST would let at 1,500 a month.
Yeah.
Whereas each room in a HMO could be 600 a month. So
yes. Yeah.
I get what you're saying, but I just think it's ignoring the debt part for now, I just think it's a fairer way to say that is an income generating asset. I'm going to value it. It's like buying a business.
Okay.
I think commercial valuations are a business.
Fine. So then, that being said, when the market is great and we're in a upward market, commercial valuations make sense. If you then go sell that to an investor or somebody else, because you're going to sell it to an investor, it's not going to be a family that are going to live in HMOs. You're going to sell that to an investor. They're going to buy it at what value?
Either. Because some investors will buy it on a yield-based calculation, or like for example, let's say this room generates 500 a month. They'll say, okay, well, I want a 10% yield on the gross rent.
Correct.
50 grand a room.
And that happens in my investment area, and it's very common. I think that's nationwide. That happens by a multiplier of the gross rent roll, and fine. But when you're then on a downward market, and so you've got a HMO that's been valued at 360,000 on a commercial valuation, but it's worth, or the bricks and mortar, someone's only willing to buy it for 300 or 275. Now you're in negative equity.
Yes, sort of
But you
drawing in the middle of it. Yeah,
but you have to, or say you by the time you sell, and so it's. I know they say house prices double every 7 to 10 years, but if you're overinflating the expectation of the property more than what it is, it's debt that you really do.
And if you have to sell quickly to a family because you just need a quick fire sale,
yeah,
you're not going to get the commercial valuation.
I'm all about having multiple exits, having multiple plans, plan A, plan B, plan Z, plan D, C, D, all the way to Z. And when you do commercial valuations, it limits your exits. Yeah, you might leave more money into the deal, but at least that way you're not overinflated. In commercial valuations, you pay higher on the interest rate and you pay more on the fees.
Is it lower LTV as well?
No, my understanding is it will be up to like 75%.
Okay, I think it's an interesting point because for a while, and I guess maybe they still are, commercial valuations are seen as the holy grail because, hey, like you said, you've added 60 grand to the value, you pull all your money back out, you carry
your
it again.
Infinite ROI.
You put a nice Facebook post up about it.
Yeah, look at my deal.
Which actually, you can get infinite ROI from buy-to-lets, by the way. It does exist.
Yeah,
if you believe in, I don't know what.
No.
But you can get it. But I think it's a lot less dangerous. I get infinite ROI on bricks and mortar valuations.
Yeah.
I think getting it on a commercial. Look, I'm not putting down people's achievements. It's still amazing that it's been valued at that. But yeah, I guess it's your view on debt, isn't it?
So now, following on your view on debt, okay, where do you want your portfolio to be in 10 years in terms of the loan to value? There we go.
Zero LTV.
Me too. If you want zero LTV, why would you, at the refinance, do a commercial valuation?
Devil's advocate. Arguably, then that means we should all at this point do 60% LTV to make it easier, but we do 75 because we can pull more out. So the argument is, commercially, we do it to pull more out, right? In the short term.
Yeah.
But what if you pulled out the extra 60 grand, whereas if it was bricks and mortar, you'd pull out 20.
Yeah. You
took that, invested in an asset that then helped you pay off the debt. I know you're creating more debt.
Again, swings and roundabouts, I think.
I think it's your risk profile, isn't it?
Yes, definitely.
Out of 10 in terms of risk, 10 being all my money on Bitcoin, 0 being I don't leave the house.
Yeah, exactly.
Where are you?
I would say I'm a healthy 5.5.
Ooh, I was going to say I'm a... How can you be a 5.5 when you do HMOs? I'm like a 3 then. Because naturally HMOs are riskier in every sense.
Okay, but I think then it's your strategy.
But you've chosen it. Your strategy is riskier than mine. I was going to say I'm a 5 or a 6.
Interesting.
But then I would be a 3 or a 4 compared to you. Just naturally.
Just because I'm doing a riskier strategy.
Yes.
But I think when I went into HMOs, now this rewind it, when I went into HMOs, I didn't go with the idea of, I wasn't thinking of risk profile, I was thinking of cash flow.
Okay, so I started with passivity and risk first.
Fine, I was like, cash flow, I need to get my trader salary back as quickly as possible. How can I do that? That's going to be HMOs.
And that's what most people do. Yeah. Whether it's a rent-to-rent HMO or you're buying it, it's still a very, very good way.
But that's interesting that you say that. Yeah, I get what you mean.
Yeah.
Makes sense.
I think with debt, right, there's obviously good debt and bad debt. Bad debt is going to Tesco's and spending too much on cheese and you earn credit card debt. Good debt is buying houses.
Yeah.
I've never done that before, by the way, don't worry. I think when you can understand the debt, and if we look at our portfolios, mine's about £750,000 of debt, leveraged. Yours is more than that, I think.
Like what you mean, like?
As in your mortgages.
Oh, I've got
75%.
over £1 million. Yeah, I've got over £1 million worth of mortgages.
But we don't lose sleep every night over that because it's normal.
Because my portfolio is also worth, X amount of more than that, and I know that it's income they're generating.
And it's normal, isn't it? It's normal to have 75%.
But if I had 700,000 or £1 million worth of debt on credit cards, I would be like.
Yeah, I mean, I don't even know. Yeah, that's mad.
I like.
A lot of apex points, maybe, but I think that's where we have to kind of, I guess, conclude it, right? Is that there's good debt and there's bad debt.
100%.
But you usually don't get worked. Oh my god, I've got a mortgage of 75% LTV. You don't think that. But if you're like, shit, I owe someone money, I'm overdue. Then you think, shit, that's bad debt. So,
okay. Question time.
Oh, dime.
Bueno, podemos hablar en español si te quieres.
Vamos.
Okay, question. you have made your millions, billions. You are a billionaire.
Mm-hmm. I
You.
don't know if I want to be a billionaire. They're scary.
But I'm
The
just
world
putting-
you get into.
I'm just putting such a
Sorry,
high,
Jay-Z.
attainable
Fine.
goal.
Billionaire. Yeah.
You're a billionaire. You've
Billionaire
got all the
piece.
assets that you want. You have all of the businesses that you want. You're successful in everything that you've dabbled in. What are you doing with your money to make it grow?
Investing in people like you who want to do the hard work. I'll just sit on my house
And how are you investing it?
on a loan agreement.
Exactly. I think we've had this conversation in private. This is the most passive way to make money is to lend it.
Oh yeah, I'm talking about in like 6-7 years. I'm lending.
Yes.
Even less. I'm lending ASAP. You do your business,
We
mate.
have not even spoken about this, and I've literally said this to some of my angel investors when they ask me where do you want to be in 5 years' time. I'm like
You. Yeah. Like please.
I want to be you lending your money out, and they say to me, "That's crazy because I want to be like you," and I'm like, "You do all the hard work. I'm tired. I'm done."
Yeah, mate. I think it comes a point. Yeah,
It's a
where,
cycle.
and also, look, but some people love property and they will do it till they're 50.
Yeah.
I personally won't, but I also know that if you can sit on your ass and get X% from someone,
Yeah,
and
100%.
you trust it, and there is your what, it works.
And I think if you've been through the process of it, you understand, you know the questions to ask.
And
as
you
well.
know what the warning signs
Like,
are. And
are you getting a RIC survey or not? Why not? What's the rationale? And every answer is okay as long as it can be justified and backed up.
But you can judge the refurbs. Now I understand and love refurbs. If I'm investing money in someone, I can go on site and be like, that's not right, the electrics aren't right, and I can say, I'm not going to invest in you again, right? So actually, we will make
Yeah.
the most pain in the arse investors. Because
Yeah.
we'll be on site and say, nah, I don't like that. Look at your copper pipes. Oh, nah, geezer, what are they? You know what I mean? Like, we are going to be the worst kind of investors.
But this is why I think I wouldn't
But-
want to go on site because I know how stressful it is.
I'd be all on site, mate.
Of your investors that you're lending your money to.
Listen, before I invest with them, I would say take me on one of your sites, talk me through everything. Let me see how compliant you are. Let me see how good your plaster is. Because I know I've done it where I've had shit
Gosh,
builders.
if you were like that to me tomorrow,
Oh, I could not work with you.
you
I
probably would be like, I'm not investing in you. And I'm like, bitch, look at my portfolio. Look what I've done.
Listen, I would love to invest in you, but I can't because we fight every day. There'll be beef every single day. But for example, I know I've had a house on a flip that hasn't been plastered in one certain area because of cost and bad builders.
Yeah.
And it's not getting the offer level I expected.
And you think that's just because of a bit of plaster?
Exactly. Yeah, 100%. Trust me. Yeah, I know because the rest of the house is beautiful. There's little clues that give it away, but I know if
Little clues.
I would have walked on site with someone else and I would have said, "What are you doing? You better fucking plaster that wall, mate. Here's £100. You better." That's my difference at the start. But once I've done one deal with someone, 2 deals with someone, I ain't coming on site. My crepes are clean after that.
But that's again about building relationships. And I think you can build the relationship without stepping on site with somebody.
Maybe. I don't know. I'm more, I don't know, conduce maybe is the word. I need to just know that I can trust exactly what is happening the first time.
Fair enough.
On that note,
But then saying that, your investors lend to you without going on site because you put out so much content on
that's
social
true. I
media.
do invite them though. I'm always like, hey,
Yeah,
come have a-
I invite my investors.
put your little swimming pool bags on your shoes, come on site.
Yeah, yeah.
And on that note, please follow us on Instagram, what's your tag?
Spot the Dave.
Tej.talks.